Good day everyone. Now we will discuss about investment management.
What is investment management? Investment management is the professional asset management of various security that including shareholdings, bonds, and other assets such as real estate in order to meet the specified investment goals for the benefits of investors. In other terms, it is the most often that refers to managing the holdings within an investment portfolio and the trading of them to achieve a specific investment objective.
The importance of investment management. The entire purpose of investment management is to increase the net value of capital assets by investing. Effective investment management creates an opportunity to explore the growth and potential markets to increase the value of clients' money. Investments are both important and useful in the context of present day conditions. So, there are some factors that have made investments increasingly important. There are longer life expectancy, the increasing rate of taxation, high interest rates, and larger income. With longer life expectancy, people need more money to live comfortably. Money should be invested in such a way that they get a fixed income every month, even after retirement. The increasing rate of taxation. Taxation is one of the crucial factors in any country which introduces an element of compulsion in a person's savings. There are various forms of savings outlet which will help in bringing down the tax level by offering a reduction in personal income. Examples are unit trust certificates, national savings certificate, bonds, post office deposits, and etc. High interest rates. Another aspect which is necessary for a sound investment plan is the level of investment risk. Interest rates vary between one investment and another. Larger income. These give rise to employment opportunities to both men and women. These, in turn, give rise to better income and larger investments and opportunities for an investment advisor.
Hello everyone, I am Mayan Sagaral and I will discuss about the criteria for selecting management. First, when considering different shapes of cash speculation, the controller ought to first consider the security of the central or principal being contributed. It would not do to contribute company reserves in an unsafe venture in arranged to win exceptionally tall returns on the off chance that there is a chance that any parcel of the foremost will be misplaced. Next, in like manner, a company arrangement ought to restrain ventures to a specific set of low-risk venture sorts. A few thought ought to be given to the development and attractiveness of a venture. Appropriately, it is best to make ventures where there's a strong showcase accessible for their quick resale. The final thought when making a speculation is its yield. This is typically genuinely the final thought after the past things have as of now been surveyed. Inside the boundaries of fitting levels of chance, development, and advertising capacity, the treasurer can at that point choose to venture with the most elevated surrender. Since these criteria tend to constrain one to exceptionally low-risk speculations, the surrender will too likely be very low. The venture criteria for a company that finds itself in a fast development circumstance are more circumscribed. It regularly burns through its cash saves very quickly, so the liquidity of its speculations must be greatly tall in a range to permit quick get to it. Tragically, tall liquidity is commonly related with most speculation returns, so the controller is constrained to contribute in low-yield ventures. In expansion, the company cannot run the hazard of misfortune on its ventures since it is fundamentally vital to keep cash accessible to nourish the company's development motor. Since chance is additionally related with return, the treasurer must, once more, favor low-yield speculations for negligible chance.
Investment options. There are a number of investment options available. Here are the most common ones that have low risk level, short maturity dates, and high level of marketability. Number 1, bankers acceptance. is an instrument that represents a bank's promise to make a future payment. The bank accepts and guarantees the payment as time draft drawn on the deposit. Number two, bonds near maturity dates. The time period during which the owner will receive interest payment on his or her investment. When the bond matures, the owner receives its par or face value back. Number three, certificate of deposit is a simple and popular savings vehicle offered by the banks and credit unions. They usually pay a fixed interest rate upon maturity, typically having duration of up to 2 years. Number four, commercial paper is a common form of an unsecured short-term debt by a corporation promised to pay the face amount on the maturity date specified on the note. 5. Money market fund is a kind of mutual fund that invests in highly liquid near-term instruments, also intended to offer investors high liquidity with a very low level of risk. Number 6. Repurchase agreement is a form of short-term borrowing, mainly in government securities. It allows the sale of a security to another party with a promise that it will be purchased again later at a higher price. Number 7. U.S. Treasury issuance are government debt security issued by the U.S. federal government that have maturities greater than 20 years.
Now, let's proceed to accounting for records of investment. So, what is accounting for records of investment mean? From the word itself, it is a systematic manner of recording information relative to the purchase or sale of investment is required. Therefore, it is where we record our purchase or sale information. In addition to the data required for lower of cost or market valuations, detailed records are necessary to provide the information needed to manage the portfolio, as well as establish and support gains or losses for tax purposes. This is an example of an investment comparison. As you can see, all the needed and related information for recording are listed here. In some cases, the file of invoices or statements from the brokers may be sufficient. These documents are the source of much information. Generally, the control should establish a control account for investment in security and support it with securities ledger. This ledger should contain the certain information. In some companies, a simple daily cash report is prepared for the CEO and treasurer, where it summarizes the cash receipts and cash disbursement, as well as the balances of major banks. Take a look on Exhibit 11.2 as an example for the daily cash report. As you can see, we need to gather all our bank movement information for us to determine the amount of our company's bank remaining balance. Let's proceed to our weekly cash report. A cash flow statement is also known as a cash flow report. It is a financial statement that sums up the amount of cash that enters and leaves an organization. Alongside with the balance sheet and income statement, the cash flow statement is a mandatory component of an organization's financial reports. The activity and investment for most industrial firms normally will be quite limited, and few reports need to be prepared. Periodic reports to management should include the name of each security, cost, current market value, effective yield, and any dividends received. For the overall portfolio, the controller should report on the overall cost, market value, and rate of return.
Cash and investment controls. Cash enters a firm through these sources: mail receipts, over the cash counter cash sales, sales or collections made by salespeople or solicitors, and over the counter collections on account. Naturally, all businesses have other cash transactions of a less routine nature, such as from the sales of fixed assets, that may be handled by the officers or require special procedures. Regardless of the source of cash, the principle of segregation of duties forms the basis of the prevention of errors and fraud. Such a system involves the separation of the actual handling of cash from the records relating to cash. Cash controls in business is cash management and internal control over cash and cash-related policies within a company. The system of internal control must be designed for each organization. However, some general suggestions will be helpful to the controller in reviewing the situation in his or her own company, such as all receipts of cash through the mails should be recorded in advance of transfer to the cashier. All receipts should be deposited intact daily. Responsibility for the handling of cash should be clearly defined. Internal control includes corporate governance, company policies, segregation of duties, authorized approvals of purchases, designated signature authority with limits, payment reconciliation, and bank account reconciliation.
Hello everyone, I am Hazel Chloe Sabuero and I am designed to report about the topic of common methods of misappropriating cash. Before we undergo the misappropriating cash, let me explain to you guys the term misappropriating or misappropriation, which means the act of stealing something that you have been asked to take care of and using it for yourself. Misappropriation of funds, money, assets. In addition, it will the segregation of duties that has been described. Certain other practices may be adopted with the further detail any would-be embezzler. What does embezzler means? It is a fraudulent taking of personal property by someone to whom it was entrusted. One of these tools is the surprise audit by the internal auditor and by the public accountants. Asset misappropriation scam includes both the theft of company assets such as cash, and the misuse and the theft of company assets such as using of company car or a personal trip. To expand this topic, here are the common examples of misappropriating cash. First is the mail receipts. Borrowing fund temporarily without falsifying any records or simply not recording all cash received, or overstating discount and allowances. Second, over-the-counter sales, failing to report all sales and pocketing the cash, and under-adding the sales slip and pocketing the difference, and also falsely representing refund or expenditures, and registering a smaller amount than the true amount of sale. Third is the collection by the salespeople, conversion of checks made to cash, and failure to report sales. Lastly, disbursement, preparing a false voucher or presenting voucher for payment twice, and raising the amount on checks after they have been signed, and cashing unclaimed payroll or dividend checks, and altering petty cash vouchers.
That's all for today, everyone. We hope that you have learned something from us.
Are you okay? Okay. You can clap with me in the classroom. Okay. Okay.